Welcome to Objective 1 in Unit 1 in Accounting 3310. In this objective, we'll talk about the fundamental accounting equation and how this simple concept can tell us a lot about companies without even going any further or any deeper into the accounting information system. Our objective here is that you'll be able to use this fundamental accounting equation to understand the structure of a company. Why is it that accountants do what they do? Well, the fundamental principle can be expressed here, and in our saying this equation, it explains everything else throughout the entire rest of the course. So it's one principle that provides the explanation for how we handle everything else in this course. I hope that you'll see this as we go through. Here's our fundamental accounting equation. Assets are equal to liabilities plus shareholders' equity. This is always true. It means that if there's a change in any one element here, then there has to be a change in another element also in order to maintain this equality. We may use this accounting equation from the point of view of shareholders. That is, shareholders' wealth is always equal to the assets in the company less the liabilities or obligations the company owes. They're completely equivalent to each other. What do we mean by assets? The specific definition is assets are probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. There are some words in here that make this definition really distinctive. First of all, assets are probable future economic benefits. So this means that companies can hold value that is going to depend on what happens in the future to know for sure if there'll actually be economic benefits. Examples of that may be particular kinds of equipment that maybe it's new, maybe it's innovative. We don't know for sure what the amount of economic benefits are going to be from it. It will still count. It can be for financial assets like investments or receivables where we don't know for sure the amount of cash that's going to be obtained from those receivables. It still counts as an asset. We'll use our best estimate. It does have to be assets that are under the control of a company, so that where we have items that are not yet under our control, maybe we've ordered equipment but we don't own it yet, that is not going to count as an asset for us yet. And it has to be as a result of a past transaction. We're not going to be able to count something as owned by us until we actually have the event take place. So we can't overstate our assets depending on some future transaction to happen. Examples of assets are as wide-ranging as cash or accounts receivable, promises of customers to pay us, tangible things like equipment and land, buying securities in another company, or even intangible things that give us rights, like copyrights give us the ability to have ownership of intellectual property, patents that give us rights to innovations, and things like customer lists that give us the ability to target our advertising. That's an intangible asset also. Liabilities in the fundamental accounting equation are parallel to those assets. They are also probable. That is, the liabilities may have some uncertainty in them, but they're still going to count. They're sacrifices of future economic benefits. So they may be paid in cash in the future, or it may be an obligation for us to perform a particular kind of service in the future. They involve a transfer of assets or to provide services to other entities. So we're going to owe people either cash or some other asset. We may have an obligation to provide them with land that we own, or we may have an obligation to provide them with the services that we provide our customers. But it's not going to count if what we have a commitment to is to provide someone with stock in our own company. So liabilities are not the result of transactions with our own owners. And again, liabilities are based on past transactions. So we're not going to have an obligation to someone else just based on anticipation. Examples of liabilities are accounts payable, which is the ordinary everyday credit that one business extends to another business. A line of credit, which is a borrowing from a bank that allows a entity to have a variable amount outstanding depending on their particular needs at a particular time. A note payable is a borrowing contract with a particular interest rate and particular payments. Unearned revenue is very distinctive. When we owe our customers because they've prepaid us, we call that unearned revenue. And there are some businesses that operate normally in that mode. When you purchase an airline ticket, you have to pay in advance, and the airline on their financial statements are recording an air traffic liability, because what they owe you is a ride in an airplane. They don't owe you your money back, they owe you a service. Likewise, you may be involved in unearned revenue transactions as a consumer when you purchase a gift card. So if you have that iTunes card that someone has purchased, they've already paid the money, and iTunes now is obligated to provide you with music downloads in the future. So that's unearned revenue on their part. Think also about benefits like vacation benefits earned. Those are liabilities to employees to provide them with days off that they have already earned and are already vested to them. That represents a liability to a company. So you can see liabilities are very wide-ranging and not just borrowing money. Owner's equity is the third element. The general term is owner's equity. We'll be concentrating on companies that are corporate entities, and so we'll be calling it shareholders' equity. But what it represents is a residual interest in the assets of the entity after deducting the liabilities. It has no separate definition apart from knowing what assets and liabilities are, and that's part of the mechanism that ensures that assets equal liabilities plus owner's equity is always in balance. Examples of equity are common stock or preferred stock. There could be particular kinds of securities with particular kinds of rights given to shareholders. It also includes retained earnings, which represents the increase of wealth in the company from providing goods and services to customers at a higher price than it costs them to provide those goods and services. We use different terms depending on the organization of the company, and so capital is going to be the term if it's a partnership or a sole proprietorship rather than a corporation. Double entry accounting recognizes that when we have a transaction take place, we must have a change in at least two items from assets, liabilities, and owner's equity. Now, it could be changes in two assets, one increasing and one decreasing. More often, it's a change in an asset and a liability, or an asset and owner's equity, or any combination of two of those three items. Let's take a look at what this fundamental accounting equation can tell us about companies. What if we have a company that has the assets of 1,000, liabilities of 500, and thus equity of 500? This is kind of our normal standard company that has about half of its funding and liabilities borrowing and about half of its funding from its own investors. If we move to a company that has assets of 1,000, liabilities of only 10, and equity of 990, this is a company that probably has no borrowings and only has incidental liabilities of the sort of accounts payable or maybe vacation benefits. This company is very conservative and may be missing out on investment opportunities because it depends on investor financing alone and does not do any borrowing. Let's flip that around. What if we have a company that has 1,000 in assets, which is funded 990 by liabilities and only has equity wealth of 10? That's a company that has a lot of risk because its obligations are enormous. If anything goes wrong, even a little bit, it may not have the funds to make good on those liabilities, and it's got only a very slim margin of error here. And so this represents a very risky company. If we move down to the bottom, we have an even riskier company. What if we have a company that has assets of 1,000 but has liabilities of 1,500? Thus, their equity is a negative 500. This is possible. You can have negative equity. It happens when a company may have some sort of event that takes place that creates for them enormous obligations. Think about what would happen if a company is in the path of a hurricane and has just disastrous destruction of its assets that doesn't relieve them of any of their liabilities. So their asset value collapses, but they still have plenty of liabilities. Or it can happen when we have a company that is unable to generate a profit from its ongoing line of business. Airlines have been in this position. Just about every airline in the last 10 years has declared bankruptcy at some point in time because it has cost them more to provide airline services to their customers than what there wasn't any way that they could cut back and be more cost effective because airplanes are such big fixed costs. So just from these three summary figures, we can learn a lot about any company. This introduces us to the fundamental accounting equation, and we'll apply it to debit and credits next. Thank you.